Before we go on to the remainder of the Chapter 20 workbook, which we have not covered, I do want to briefly review the concept of contribution margin. Even though we went over it in class, I think it's worthwhile reviewing one more time. Now, what you see here is a contribution, in effect, a cost, volume, profit, income statement. It starts off with revenue. We have our various deductions from revenue, and we end up with net income. Now, let's take a look at how the cost, volume, profit, financial income statement has been created. We start off with revenue, our total revenue, less our variable costs, the variable cost of producing that revenue. From that equals the contribution margin that the revenue minus variable cost produced. The contribution margin is what's left over after we have paid for all the variable costs that were necessary to produce the revenue. Then from the contribution margin, we can subtract out our fixed costs, and then after we subtract out our fixed costs, we hopefully end up with some form of net income. So there's a couple of takeaways from this income statement. First of all, revenue again minus our variable costs equals our contribution margin, and our contribution margin is what is left over after we paid for our variable cost of production. Our contribution margin then is available to, number one, cover our fixed costs, and after we've covered the fixed costs, the contribution margin is available to produce net income. So with that concept in mind, let's take a look at the concept of unit contribution margin. And the difference between contribution margin and unit contribution margin is pretty simple. Contribution margin is for the entire income statement. Unit contribution margin is measured on a per unit basis. So unit contribution margin states it's the amount of revenue remaining per unit after paying our variable cost per unit of our production sales, or basically of our volume. In effect, this unit contribution margin is the amount of revenue that we generate, again, per unit, that will cover, first of all, our fixed costs, and then number two, after we've covered our fixed cost, it will then generate or contribute to net profit. Now, the unit contribution margin is a very simple calculation, and it is our unit selling price minus the unit variable cost. So it's the selling price per unit minus the variable cost per unit. Now let's take a look at an example of that formula. The selling price per unit is $60 a unit. We have variable costs that are $30 a unit, and our company has total cost of $120. So now let's calculate the unit contribution margin. $60 selling price minus the $30 variable cost equals a $30 unit contribution margin. So what that means is every time we sell a unit, there will be $30 of contribution margin contributed to covering fixed cost, and if the fixed costs are covered, basically to generating our net income or net profit. So let's take this example of the $60 sales price, the $30 variable cost, and the total fixed cost of $120, and see how this actually works. Okay, at the very top I show the $60, the same equation we had from the previous slide. And that's our $60 selling price minus our $30 variable cost equals our $30 unit contribution margin. We'll also know that the total fixed cost for the company is $120. Now we're going to follow the volume of our contribution margin and its impact on the net income or loss for the company over a volume between 0 and 6, as you can see by this arrow. Now, what you see at the bottom of the arrow where I show a volume level of 0, I have no unit contribution margin, so that's 0 unit contribution margin. So my accumulated contribution margin would be 0 plus my current contribution margin is 0, and that all equals 0. So I then take and apply that against my fixed cost, and of course I have no contribution margin to apply to my fixed costs, so I have a net loss of $120. Now let's assume that I end up selling, or I have a volume of 1. So here my unit contribution margin for that 1 unit is $30. So if I want to calculate my accumulated contribution margin, it's 0 from the previous level plus the $30 I just contributed from my unit contribution margin. So my total my accumulated contribution margin is $30, and that is going to cover $30 of my fixed costs. So now my net loss is no longer going to be $120, it's going to be $90. Okay, now I'm going to assume that I'm going to have sold 2. So I'm going to have, again, they're going to be at the same contribution margin of 30 per unit. So that would include 30 from the previous sale plus the 30 from the second unit, meaning my unit contribution margin will be $60. I then will have $60 can be applied against my $120 worth of fixed cost, and I'm going to end up with a net loss now of $60. Then I go on to my third item in volume, and I've accumulated $60 of contribution margin so far on my first 2 units. Now I add another $30 of contribution margin to represent the third item in my volume, and now my accumulated contribution margin now is $90. $90 then I apply against my fixed costs, and again I still don't have enough contribution margin to reach or to basically equal my fixed costs, so I have a net loss of $30. Now we go on to the fourth item that we would sell. Again, it has a unit contribution margin of 30. I had $90 worth of contribution margin from the previous volume, plus I add another $30 for my current unit contribution, and that's $120. Now I compare that against my fixed cost of $120, and I find now I can cover all $120 of my fixed cost with my accumulated contribution margin. So my net income / loss is now equal to 0, and again, that is where I break even, where my total revenues equal my total expenses. Now I go on to a volume of 5 units. So my unit contribution margin is still going to be $30 for that unit. So I take my previous accumulated contribution margin of $120, add $30 to it, and now I have $150 of accumulated contribution margin compared to my fixed cost of $120. And now you can see that not only have I covered my fixed cost, but now because I've covered my fixed costs, now my contribution margin is contributing to net income. Okay, now we go on to the volume of 6. Again, a $30 contribution margin. My accumulated contribution margin from the first volume of 5 items is $150, plus my $30 additional contribution margin. Now my accumulated contribution margin is $180. We compare that to our fixed cost of $120, and you can see now my net income is equal to $60. So what this does is this illustrates that with an increase in volume, every dollar of the unit contribution margin first covers my fixed cost, which are between 0 and 3, and then it contributes to net income between a volume of 5 and 6, with a volume of 4 being my break-even point. Now we're going to take a few minutes and review the concept of break-even point again. And it answers the question, how many units must I produce and sell in order to break even? So the formula for this again is very simple. It's my total fixed costs divided by my unit contribution margin. So total fixed cost divided by unit contribution margin. Let's take a look at this example. A company sells product A for $25 a unit. It costs the company $10 a unit to produce product A. So we have a selling price and we have a variable cost. The company has $45,000 of total fixed cost during the accounting period. Now the question here, this is worded incorrectly, but the question should say, what is the unit break-even point? So what is the unit break-even point? So the answer in that case would be, we can now use our unit break-even point formula. And it is going to be our total fixed cost of $45,000 divided by our unit contribution margin. And our unit contribution margin will be our selling price of $25 minus our $10 variable cost. Now I didn't insert those in there, but you can assume it was a $25 selling price minus my $10 variable cost. That leaves us with a unit contribution margin of $15 a unit. So if we divide the $45,000 fixed cost by the unit contribution margin of $15 a unit, that results in a volume of 3,000. So what that would mean is we would need a volume of 3,000 units in order to break even. Now let's go ahead and take a look at the basically using the cost, volume, profit, or contribution margin income statement, if you will. Let's go back and prove this. Okay, we start off with the revenue. The revenue is going to be $25 selling price a piece times those 3,000 units we talked about. So the dollar amount would be $75,000. Now we have our variable cost, which are $10 a unit. Again, times our volume, and that would be a $30,000. So now our contribution margin is going to be $45,000, which is our $75,000 minus our $30,000. And then we subtract out our fixed cost, and our net income is equal to 0. So what we can see is at a unit volume of 3,000, given a $25 selling price and a $10 variable cost, we're going to be able to break even again at 3,000 units. Now let's take another example here. Starboard Corporation has fixed cost of $900,000. It has its products are sold for $50 per unit, and the variable cost are $40 a unit. So we want to compute the unit break-even point for the product. So let's go and take a look at the formula. It's going to be our $900,000 fixed cost divided by our contribution margin, and our contribution margin is equal to our $50 selling price minus our $40 variable cost. So that's going to be, in effect, we're going to have a unit contribution margin of $10. So we divide the $10 into the $900,000 fixed cost, and we come up with the volume of 90,000 units. So what this says is it will take us 90,000 units in order to break even. So if we go back and review the computation, we have revenue of $50. We have a $50 selling price times 90,000 units. That gives us total revenue of $4,500,000. We have variable cost of $40 per unit times 90,000 units. That gives us variable cost of $3,600,000. So therefore our contribution margin comes out to $900,000. We subtract out then our fixed cost of $900,000 and we end up with net income equal to zero. Again, our break-even point. Let's take a look at this calculation. Rose Limited had $36,000 of fixed cost. The company sold its product at $20 a unit, so we know our selling price. The cost to make each unit is $14, so that's our variable cost. Compute the unit break-even point for the product. So again, we can use our formula. Our total fixed cost of $30,000 divided by our unit contribution margin, which is our $20 selling price minus our $14 variable cost. So it's going to be $36,000 fixed cost divided by our unit contribution margin of $6. We do the division and it comes up to a volume of 6,000 units. So that 6,000 units are our break-even point. And if we want to prove that, we can take the $20 selling price, $20 a unit, times a 6,000 volume. That comes up to $120,000. Variable costs then are going to be $14 a unit times 6,000 units. That's $84,000. So our contribution margin comes out to $36,000. And therefore, our fixed costs are going to be $36,000. And we come up to a net income of $0. And so let's go on to the next part of our demonstration. Okay, we're going to start off almost from where we left off in our class. And just for a very quick review, the last subject area we went over was the contribution margin ratio. And the contribution margin ratio, again, answers the question, what percentage of the sales price of each unit is available to cover our fixed costs and then earn a profit? And as you can see here, we did several examples in steps on how to actually calculate the contribution margin ratio. And again, the contribution margin ratio, the formula itself is very simple. It's the contribution margin itself divided by the selling price. So let's go on to the next slide. And we did perform a calculation on the next slide. And that showed that, again, when we applied the formula, the selling price minus the variable cost, which equals the contribution margin, divided by the selling price, equals our contribution margin ratio. In this example here, it was our unit contribution margin was $15 and our selling price was $25, meaning that we had a 60% contribution margin ratio. Now we're going to apply the same process to this next example. And here we have a company, Starboard Corporation, that has total fixed cost of $900,000. Its sales price is $50 a unit, and the variable cost of producing and selling it are $40 a unit. So it wants you to compute, the problem wants you to compute the contribution margin ratio. So what I'm going to do is take the contribution margin ratio formula from right up here, and I'm going to place it in right above so I have a guide for my second problem. So again, it's going to be my selling price, which is $50 per unit, minus my variable cost of $40 a unit. Now those two items together will give me my unit contribution margin. But I'm going to have the $50 selling price minus my $40 variable cost divided by the $50 selling price, that should be SP. Therefore, that is ultimately going to equal my $10 unit contribution margin divided by my $50 selling price, and that equals 20%. So the unit contribution margin would be equal to 20%. Now let's take a look at the next problem. At a volume of 5,000 units, Port Corporation has total sales of $150,000. Total fixed cost of $20,000 and a net income of $30,000, and from this information you are asked to compute the contribution margin ratio. So we're not necessarily being told the selling price or the variable cost per unit in this case. We're going to have to calculate it in a slightly different way, utilizing the formulas that we are already familiar with. So the first thing we can do is we can utilize our classic cost volume profit formula, and that's sales minus variable costs minus fixed cost equals our net profit or net income. And in this case I plug in the numbers. $150,000 of sales. I don't know what my variable costs are because I'm not told that in the problem, so I'm going to leave that as a variable. And I have $20,000 of fixed costs, and I do know I have a net income of $30,000. So now I've completed the formula. Now I have to solve for X, which happens to be my variable costs. And obviously it's very simple algebra. I take my $150,000 of sales minus my fixed cost equals my net income. So the variable cost must have been $100,000. So when I do this and I check the formula, 150,000 minus 100,000 minus 20,000 does equal $30,000 net profit. So now I've completed the entire cost volume profit formula. So now it's just a matter of calculating a contribution margin and contribution margin ratio. Now the way I do that is I take my total sales and I subtract out my variable costs. That's going to give me my overall contribution margin. I take my contribution margin then and divide it by my total sales of 150,000, and I end up with the contribution margin ratio of 33.3%. So that's another way of solving for a contribution margin ratio when you're given different sets of information to work with. Now let's go on and talk about some other subject matter. And this is calculating a break-even point in sales. And this answers a question. Given that you have a unit sales price, in other words your selling price, you also know your variable cost per unit and your total fixed costs. How many sales dollars or how much sales dollars must be generated to break even? So how much do we have to have in sales in order to break even? So let's take a look at the break-even point in sales formula, and it's actually a very simple formula. We take our total fixed cost and we divide that by our contribution margin ratio. So again, total fixed cost divided by your contribution margin ratio. So let's try an example of this. We have a company that sells product A for $50 a unit. It costs the company $30 a unit to produce product A. The company has $60,000 of total fixed cost during the accounting period. So what's the break-even point for this company in terms of total sales? So again, we can take a look at the break-even point in sales formula, and it's our fixed costs divided by our contribution margin ratio. And you can see here the contribution margin ratio is represented by our selling price minus our variable cost, which equals our contribution margin, divided by our selling price equals our contribution margin ratio. So we plug the information in from our problem. We have $60,000 worth of fixed costs. That's divided by our contribution margin ratio formula, which is our $50 selling price minus our $30 variable costs divided by the $50 selling price. When we perform that, then we get $60,000 of fixed costs divided now by our contribution margin ratio of 40%. And what that tells us is we have to generate $150,000 worth of sales in order to break even. $150,000 in sales in order to break even. Okay, now let's try one more problem in this area. So let's go on to the next problem. Starboard Corporation has fixed cost of $90,000, sales price of $50,000, and variable cost of $40,000. So in this case, again, compute the break-even point in sales. So let's take a look. Okay, now I'm going to reproduce again my break-even point in sales formula. Basically my fixed cost divided by my contribution margin ratio formula. I go on then, I have $900,000 worth of fixed costs. So that goes in the formula. I know my selling price is $50 per unit, and I know my variable costs are $40 a unit. So I'm going to have a total contribution margin here of $10 per unit divided by my $50 selling price, and now I'm going to get generate a contribution margin ratio. So it'll be $900,000 in fixed costs divided by my 20% contribution margin ratio, and that means I have to generate $4,500,000 in sales in order to break even, given my selling price of $50, my variable cost of $40,000, and $900,000 of fixed costs. Okay, now let's go on to another break-even formula. We just did break-even point in sales. Now we're going to deal with the concept of target net income. We're no longer going to be worried about breaking even. What we are concerned with now is not only do we want to break even, but we want to earn net income. So we can calculate what our target net income would be at a given or what a given amount of sales, or a given amount rather of units would have to be produced in order to earn our target net income. So let's take a look at the formula. And it's the volume of units necessary to achieve a target net income. That is going to equal our total fixed costs plus the target net income or target net profit, those two items combined, divided by our contribution margin per unit. So total fixed cost plus our target net income divided by our contribution margin per unit. So here we're given a problem. Given the following information, how many units must be produced to earn $25,000 of net income? So again, we can basically insert the numbers within this contribution, this target net income formula. We take our $15,000 of fixed cost. We have a target net income of $25,000. So those two items have to be covered by our contribution, our unit contribution margin, which is calculated as our selling price of $120 minus our variable cost of $80 per unit. So what that means is, when we crank through that formula, we have $40,000 of what I call FCTI, and that's just a combination of the fixed cost and target income. That's what fixed cost target income, $40,000. We divide that by our $40 unit contribution margin, and when we do that, that means we have to achieve a volume of 1,000 units to basically produce and sell in order to achieve our target net income, in this case of $25,000. And if you want to prove it to yourself, I show it right here. Again, we've inserted the sales price and the variable cost. There is a volume we've calculated. The calculations of 120,000 minus 80,000 variable cost equals a contribution margin of $40,000 minus our fixed cost gives us a net income, and that's our targeted income of $25,000. Now let's take a look at a couple more calculations regarding target net income. So we have a problem here where the selling price per unit is $100, the variable cost is $60, and the fixed costs are $200,000. Now how many units, again, how many units must be produced and sold to earn a target income of $600,000? So again, we can take our formula from the previous page, which is we have to cover our fixed costs plus our target income. And we have to cover that with our contribution margin, unit contribution margin. And that's our selling price minus our variable cost. When we drop in the numbers into the formula, we have $200,000 worth of fixed costs plus our $600,000 of target income. That quantity then should be divided by our selling price of $100 minus our variable cost of $60, and that's going to equal our unit contribution margin. So ultimately we're going to have $800,000 of fixed cost and target net income, and we're going to divide it by our unit contribution margin of $40 a unit. When we do the calculation, that means we have to generate a volume of to produce and sell 20,000 units in order to break even. So that's our calculation for that problem. Now let's go on to the next exercise. The selling price in this case is $30 a unit, the variable cost is $20, and the fixed costs are $60,000. So how many units, again, how many units must be produced and sold to earn a net income of $100,000? So let's do the calculation. Okay, again, I didn't reproduce the formula. I've just done the calculation directly from the formula up above. We take $60,000 of our fixed cost right here, and to that we add our target net income of $100,000. So we have our fixed cost plus our target net income. We're going to divide that now by our unit contribution margin, which is going to be our selling price per unit minus our variable cost per unit of $20. So when we reduce the calculation, 60,000 plus 100,000 is going to be a total of 160,000 between fixed costs and target net income, and we're going to divide that by our unit contribution margin, which is our unit selling price minus our variable cost, and that's going to be $10. So when we do the calculation, our volume is going to be $160,000. Or sorry, 16,000 units, not dollars, 16,000 units. Now let's take a look at the next formula, and the last formula is we calculated our target net income in units. Now we're going to calculate our target net income in sales. Instead of units, it'll be in sales. So what we do now is, it answers the question given a unit sales price and the variable cost per unit and our total fixed cost. In other words, when we have that information, how many units, and in this case I do have an error, it's not how many units must be produced, it is how much sales must be produced to achieve a target net income. So in this case, it's how much sales must be produced, not units, but how much sales must be produced in order to achieve a target net income. Let me cross out that unit area. Okay, let's go ahead and take a look at the formula. It's our total fixed cost plus our target net income. That's just like the same beginning, the numerator that we had in our previous formula for target net income for units. But instead of using our contribution margin per unit, what in this case is we're going to use, and again I'm going to have to change this a little, but we use our contribution margin ratio, not our contribution margin per unit, but our contribution margin ratio. Now let's go ahead with these corrections to the formula. Let's go ahead and do the calculations. Okay, we have an example where it's asking us how many units, and again, that should be how much in terms of dollar sales. Let me change that. How much in sales must we generate to earn a $55,000 net income? So let's take a look at the calculation. Okay, we have our formula now for the target net income in sales. It's going to be equal to our fixed costs plus our target income, and then from that we divide that by our contribution margin ratio formula. So let's go ahead and fill in the components of this equation. Okay, so we take the, before I went on, let me cross out these two areas here with I just wrote through. Our formula looks like the following. We have $15,000 of fixed costs. We have a target net income of $55,000. Okay, now we divide that by our contribution margin ratio. In order to calculate that, we take our selling price of $1.20 or $120 per unit minus our variable cost of $80 per unit, and we divide that by our selling price again of $120 a unit. So when we combine our fixed cost and our target net income, that comes up to fixed cost target net income total of $70,000. When we calculate the contribution margin ratio from this formula, it comes out to 33.3%. That means we will have to generate a total of $210,210.21 worth of sales in order not only to break even, but earn a target net income of $55,000. Now, I've left this down here in your workbook if you want to go ahead and try to prove this formula out. I will tell you it will not come out exactly because we have to use a fraction of a decimal. It'll come out close, but not exactly if you try to prove it. In our class, we had just gone over a formula on how to compute target net income in the number of units it would take to achieve that target net income. We also went over an example, plus we did a proof showing you that the formula that I provided you works. Now let's try a couple of exercises regarding how do we compute the number of units necessary to arrive at a target net income. So exercise 1 tells us about the selling price is $100, the variable cost per unit is $90, and the fixed cost is $200,000. And the question is, How many units must be produced and sold to earn a net income of $600,000? So what I produced over here on the left-hand side is the formula for computing target net income in units. And it's the quantity of fixed costs plus our target net income divided by our contribution margin. So what I'm going to do is convert that formula now into all of its variables. And that's my fixed cost plus my target net income, and that's divided by my contribution margin, which is basically my selling price minus my variable costs. Now I can go ahead and populate my formula with the available data. I need fixed costs, so I know I have $200,000 worth of fixed cost. My target net income is $600,000, so I insert that. I also have my selling price, which is $100 per unit, and my variable cost, which are $60 per unit. So now I populated my entire formula, so let's simplify it. And it's going to be $800,000 now divided by a $40 contribution margin. And in order to get the number of units that I'm going to have to produce and sell in order to earn a net income of $600,000, I just divide by the 40 by the 800,000, and I end up with the volume of 20,000. So that's saying what I will need is I will need to produce and sell 20,000 units given the selling price, my variable cost, and my fixed cost in order to achieve a target net income of $600,000. Let's go on to the next exercise and take a look at this. Again, we have a selling price of $30 a unit, a variable cost of $20 a unit. We also have our fixed cost of $60,000. And the question is, how many units, how much volume must be produced and sold in order to earn a net income of $100,000? Again, we take a look at our formula. Our fixed cost plus our target net income divided by our contribution margin. If we display all the variables in our formula, it's our fixed cost plus our target income divided by our contribution margin, which is our selling price minus our variable costs. So now we can populate the formula. I start out with my fixed cost. My fixed costs are $60,000, so I insert those into the formula. I now also need to come up with my target income, which is $100,000. That's inserted into the formula. That's going to be divided by my selling price minus my variable cost. So my selling price is $30 a unit minus my variable costs, which are $20 a unit. So I'm going to go ahead now and reduce the problem. And now it's $160,000 divided by a contribution margin of $10 per unit. So in order to arrive at the volume I'm going to need in order to not only cover my fixed costs but produce a net income of $100,000, I'm going to have to generate a volume of 16,000. I'm going to have to produce and sell a volume of 16,000 units in order to earn a net income of $100,000. Okay, let's go on to the next slide, and this next slide is on computing target net income, but in this case it's not computing target net income on units, it's computing target net income in sales, and that means sales dollars. And if we give you the definition, now before I read through this definition, please note there are some words that I've written in red. After fixed cost, if you would replace that line with the words written in red, it'll be a much better, more precise definition. So please don't forget to cross that the line out after total fixed costs and insert those words in red. So target net income in sales, it answers the question that if we're given a unit sales price and if we know the variable cost per unit and our total fixed cost, we can then determine how much sales must be generated, and those are sales dollars. How many sales dollars must be generated to earn a target net profit? And again, we see the formula written out here, and it's total fixed costs plus our target net income divided by our contribution margin ratio. Remember, the previous formula was total fixed costs and target net income, but that was divided by our unit contribution margin. In this case, it's our contribution margin ratio. So let's try an example. Okay, given the following information, how much sales, and you can cross out units, so how much sales must we generate to earn $55,000 of net income? So I've reproduced the target net income in sales formula, fixed cost plus target income, divided by my contribution margin ratio. I also know my selling price is $120 a unit, my variable cost is $80 a unit, and I have total fixed costs of $15,000. So again, I'm going to take my formula and break it down into its variables. And again, it's going to be my fixed cost plus my target income divided by my contribution margin ratio, which consists of my selling price per unit minus my variable cost per unit divided by my selling price. So again, I can insert all the information that I have here into those variables, and I'm going to end up with $15,000 of fixed cost plus $55,000 of target income, and I'm going to divide that by my $120 selling price minus my $80 variable cost, and there should be a bracket between the $120 selling price and the $80 variable cost, just so you know that. But then that quantity is divided by my $120 sales price. And what that'll come out to is, when I reduce the equation, it will be $15,000 plus $55,000. That's going to equal $70,000. And when I calculate my contribution margin ratio, it's going to come out to 33.3%. So I divide the 33.3% into the $70,000. And what this says is, in order to not only break even, but earn $55,000 worth of net income, I'm going to have to generate $210,210 worth of sales. Now, what I'm going to do is show you the proof on the next page. Remember, our selling price is $120, our variable cost is $80, fixed cost $15,000. Now, when we take a look at our contribution margin income statement, the one thing I can tell you right away is we just can't drop in numbers. We have to make one additional computation here, because this contribution margin income statement requires a volume, which we don't have from the problem. So we're going to have to compute the volume. So the question is, how many units must be sold in order to earn $210,210. Now, we know we have a sales price of $120 per unit. So if we can divide that into the $210,210, we're going to come up with a volume. So we take our total sales of $210,210 and divide it by our selling price of $120, and we come up with a volume of 1,752, and it's actually a little bit less than that, but I have it rounded up to 1,752 in terms of volume. Now that I have the volume, I can plug that into my contribution margin income statement, and I can come up to a reasonably good approximation of the proof here. I compute my total revenue, and the way I do that is I'm taking my $120,000 selling price times the volume I just computed, which is 1,752. In this case, it comes out to 210,240. Now, in theory, it should have come out to 210, but again, I rounded that up, so there's $30 extra there. I also look at my variable costs. They're $80 per unit, and I have to multiply them times 752 full units. So that's going to turn out to be $140,160. So again, that amount would actually be a little bit less. But my contribution margin, now that is computed off of the volume of 1,752, ends up being $70,080 From that, then I subtract my fixed cost, and I end up with a net income of $55,080. And in theory, it should be $55,000, which is the proof. But because of the rounding issues, it came off a little bit, so it ended up as 55,080 as opposed to 55,000. But you can see that that is pretty much the proof. If I actually use the individual fractions of the volume I needed to do, it would come out a little bit more. It would come out, well, I shouldn't say a little bit more. It would come out a lot more. The net income would come out a lot closer to $55,000. But I think you understand the process. Okay, now let's try a couple examples of basically target net income in sales dollars. In this case, we have a company called Buckets of Bits. It sold ink jibs at a price of $25 each. It cost $12.50 to manufacture each ink jib. Buckets of Bits had $250,000 of total fixed cost. What sales dollar amount must Buckets of Bits achieve to earn a net income of $500,000? So again, we have our target net income in sales formula right here, fixed cost plus target net income divided by contribution margin ratio. So again, I'm going to break the equation down into its variables. And here we go again. Fixed cost plus target income divided by my selling price minus a variable cost divided by my selling price. So I can populate now the information in my equation from the data up here in the description of the exercise, and I come up with $250,000 of fixed costs. Add to that $500,000 of target net income divided by my contribution margin ratio. My contribution margin ratio is going to be my $25 selling price minus my $12.50 variable cost divided by my $25 selling price. So now I'm going to reduce the equation, and it's now going to become $750,000, and when I calculate out the contribution margin ratio, it comes out to 50%. So I divide 50% into the $750,000, and that tells me I'm going to need sales of $1,500,000 to not only cover my fixed cost, but also produce $500,000 of net income. Let's try this next exercise. Now, using the same cost information above, let's just assume that Buckets of Bits decides to raise its sales price to $30 a unit. If we do raise that sales price, what sales dollar amount are we going to have to achieve to earn a net income of still that $500,000? So what is our sales level that we're going to have to achieve in order to earn the $500,000 net profit? Okay, again, we create all the variables for the formula like we've done before. Okay, then we go ahead and based upon the variables in the formula, we're going to populate the information from the information in this part of the exercise and also the top exercise. So in this case, we have $250,000 worth of fixed costs like we had before. Our target net income is the same, $500,000. Okay, the one difference we have is our selling price is gone from $25 to $30. So now our selling price is $30, but it's still minus our variable cost haven't changed, so it's $12.50 divided by our $30 selling price. Again, when we reduce the equation, it's $750,000 divided by, now in this case, 58.3% contribution margin ratio. If we divide the contribution margin ratio in the $750,000, that indicates that in order to not only break even but earn $500,000 of net profit, given that after we raise our sales price to $30 a unit, the amount of sales that we would have to generate now is $1,286,449.
The next area we need to deal with is what we call computing a margin of safety. And the margin of safety isn't really that difficult to compute. It's basically the dollar amount by which our actual sales volume exceeds the break-even sales volume. So if we have a break-even sales volume of $50,000, that means where we're not making money or losing money. Anything above the break-even sales volume can be measured as a margin of safety. In other words, if our break-even sales volume was $50,000 and we were making $75,000, we could say we have a margin safety of $25,000. In other words, our sales could fall by $25,000 till we get to the point where we'd be simply breaking even. So this is best illustrated utilizing an example. So we have a company called Cedar Fair, and they sell computer servers for $3,500 each, and the cost of each server is $2,800. So that represents the variable cost. Cedar Fair also has total fixed cost of $7 million a year. So let's say the CEO of Cedar Fair wants to know what is the company's margin of safety if they achieve sales of $42 million a year. In other words, the CEO is really saying is how far could our sales drop before we hit the break-even point. So I'm going to show this computation to you in 4 steps. You can combine these steps in any way you want. You just have to achieve the same objective. So let's start off with step number 1. We need to calculate the contribution margin. So in step number 1, our contribution margin is our selling price minus our variable cost. So the selling price per unit is $3,500 and our variable cost per unit is $2,800. So we have a $700 contribution margin. Step number 2 then is compute the contribution margin ratio. And that's our contribution margin ratio is our contribution margin divided by our selling price. And we have a $700 contribution margin that came from step number 1 where we calculated the contribution margin. We divide that contribution margin by our sales price, and that comes out to 20%. Okay, we go to step number 3 now is we want to calculate the break-even point in sales. And again, you notice these are all formulas that we have utilized before. We've done a contribution margin formula. We've calculated contribution margin ratio before. Now we're going to use the break-even point in sales formula. And that's got our fixed costs divided by our contribution margin ratio. Again, we're told we have $7 million of fixed cost a year. There's our $7 million. We divide that by our 20% contribution margin ratio we calculated in step 2, and that's going to come out to $35 million. So what that's saying is if we were at a sales level of $35 million, we'd be right at break even. So now we need to compute the margin of safety, and the CEO said, compute my margin of safety if we were making $42 million. So we take our, basically the sales minus our break-even point in sales. So we take our $42 million in sales, or projected sales, whatever you want to call it, minus our $35 million break-even point in sales, and that means the difference between the two is a $7 million margin of safety. We could basically have sales drop by $7 million to the point where we were at break-even. Okay, now let's take a look at another example of calculating margin of safety. Lake Erie Pure Water sells bottles of water for $3 a bottle. The cost of each bottle, the cost of producing each bottle is 75 cents per bottle. The company has fixed costs of $2,700,000 a year. And the question is, what is the company's margin of safety at a sales level of $3,800,000? So again, as I mentioned, these steps can be combined, but I'm going to show them to you separately. Just make sure that you understand each step. Number one is we need to calculate the contribution margin, which is our sales price minus our variable cost. Our sales price is $3 a bottle, and our cost per bottle is 75 cents. That means we have a contribution margin per bottle of $2.25. Now we need to calculate the contribution margin ratio, which is our contribution margin divided by our selling price. And that is our contribution margin is $2.25 divided by our $3 sales price, which means our contribution margin ratio is a nice healthy 75%. Step number 3 then is we have to compute our break-even point in sales. So we use our break-even point formula, a break-even point in sales formula, which is our fixed cost divided by our contribution margin ratio. We know our total fixed costs are $2,700,000 a year, and we know our contribution margin ratio from step 2, which is 75%. So we divide the 75% into the $2,700,000 fixed cost, and we end up with our break-even point in terms of sales of $3,600,000. Now we want to compute the margin of safety. So it's basically our sales or our projected sales, and we subtract out our break-even point. So in this case, what is the company's margin of safety at a sales level of $3,800,000? So we're using that as our measure. So we take $3,800,000 in sales less the $3,600,000 break-even point in sales, which we got from step number 3, and that's going to have a margin of safety then. We have a margin of safety of $200,000, and that would be the answer to this particular exercise. Okay, here's another example of where we can use this is utilizing a contribution margin ratio, and we use the contribution margin ratio to predict changes in our net income with changes in volume. Now let's use an example. We have a company here called, again, Cedar Fair. They sell the computers for servers for $3,500 each, and the cost of each server is $2,800 like our previous examples. And our company's fixed costs are $7 million a year. Now, the company expects to increase sales from $42 million to $49 million with the sale of 2,000 additional servers. That means our volume is going to increase by 2,000. So what is the projected increase in operating income? And we can apply a simple formula to our projected volume increase and come up with what we consider to be our projected our increase in our contribution margin, therefore net income. And it's our increase in sales times our contribution margin ratio. That's going to equal our dollar increase in contribution margin. So let's see how that works. Okay, so again, we're assuming we're having an increase in volume of 2,000 servers, and that's going from 42 million to 49 million in sales. So the first thing we want to do is we want to note that we have $700 contribution margin per unit in our computer, which is the difference between the $500 selling price and the $2,800 variable cost of each of the servers. Okay, we're going then to calculate the contribution margin ratio by taking that $700 contribution margin, dividing it by our $3,500 selling price. In this case, our contribution margin is going to be a 20%, or sorry, the contribution margin ratio is going to be 20%. Now that we know our contribution margin ratio is 20%, we can apply any increase or decrease in sales, and based upon that contribution margin, we can predict what's going to happen in terms of the impact on our contribution, therefore net income. Now, we're assuming right now that our sales are going to increase from $42 million to $49 million. That means we have a $7 million increase in sales. Now, the question is, what is that going to do, that increase in sales, what is that going to do to our contribution margin and our net income? So we take the $7 million increase in sales, we multiply it times our contribution margin of 20%, and based upon that then, we would know as if our sales increased by $7 million, everything else being equal, our contribution margin would increase by $1,400,000. And since our fixed costs are fixed, that would also increase our net income by $1,400,000. Now down here I have a little bit of a proof how that would work, and I'm not going to go into the details, all the financial statement information here, but what you can see is I have 12,000 units. I've been increasing my volume by 2,000 units. So it's going from 12,000 units to 14,000 units. And again, if I calculate out my total sales with my selling price at $3,500 each, at 12,000 units, I'm going to generate those $42 million in sales. And at 14,000 units, those sales are going to go up to $49 million, just like we talked about up here. I'm also going to have an increase in my variable costs because as my volume increases, my variable costs also increase. But by the same token, I'm going to have an increase in my contribution margin of $8,400,000 and $9,800,000. My fixed costs are going to stay the same. So my net operating income at the end of the day is going to be $1.4 million for 12,000 units, and it's going to go to $2.8 million for 14,000 units. Now you'll notice that the change in net operating income between those 12,000 units and 14,000 units, or if you will, $7 million in sales, equals what I predicted, the $1.4 million out of the contribution margin ratio. So that's how we can measure changes in contribution margin. Deco Corporation manufactures picture frames. The frames sell for $24 each. The company is operating at a profit. Information about the company's cost is as follows. We have $10 manufacturing cost per variable manufacturing cost per unit. We also have some selling and administrative expenses, which are also variable. Then we have fixed manufacturing overhead and fixed selling and administrative costs. Now the exercise says estimate the amount by which monthly operating income will increase if the company anticipates a $200,000 increase in monthly sales volume. So the first thing we need to do is we need to calculate our contribution margin. Because eventually we're going to want to use our contribution margin ratio to apply to our change in sales volume. So let's start off by calculating the contribution margin. We know our selling price is $24 each, so there's our selling price. From that we have to subtract our variable costs. But we also have to remember, and that's where this problem can confuse students, is this includes all of our variable cost. Remember, a variable cost can be any type of cost. It can be an inventory cost, it can be some form of period cost, administrative cost, selling expense, and so forth. So in this case we have selling and administrative costs, which are variable per unit of $2. So what we have to realize is that we have total variable costs of $12 per unit. So it's the $24 selling price minus the $12 variable cost per unit. That means our contribution margin per unit is going to be $12. Okay, now we're going to calculate the contribution margin ratio. So we take our contribution margin from our previous step, we divide it by the $24 selling price, and we end up with a 50% contribution margin ratio. Now I could have just as easily combined these two steps together, but again I've separated them just to illustrate the process. The next item then is we're going to take the contribution margin ratio and apply it to our increase in sales. So we anticipate a $200,000 increase in our monthly sales volume. So we have a $200,000 increase in sales times our 50%, and that should read CMR, contribution margin ratio, not CM, but contribution margin ratio. That equals a $100,000 increase in our overall contribution margin, and if our fixed costs do not change at all, that means that's going to also flow through then as a $100,000 increase in our net profit. Okay, for our last formula exercise, we're going to go through what we call calculating a break-even point in sales, which we've done before, but in this case it's going to be for multiple products, which we haven't done before. We've done break-even point in sales for one product, but if we have more than one product, we have to adjust our calculations. So this is best illustrated through an example. We have a company called ILS, and it sells two products. Product A sells for $45 a unit, and it costs us $20 to make. So that's our variable cost. The company also sells product B for $45 a unit, but its cost to produce is a bit different. It's $30 a unit, so the cost to produce product B is a little higher than product A. The company has total fixed cost of $400,000 a year. ILS plans to sell a product mix of 30% of product A and 70% of product B. So that's the approximate sales mix ILS plans to end up with. So what we need to do now is we need to calculate our contribution margins for product A and B. So let's go ahead and try that, or do that rather. Product A, we start out, we have a sales price of $45 a unit minus our variable cost to produce of $20 a unit. That means product A has a contribution margin of $25. Okay, now we take a look at product B. Product B has a sales price again of $45 a unit, but the cost to produce product B would be $30. So our contribution margin for every unit of product B would be $15. So now we have two separate products, and it's complicated by the fact that each of these products has different contribution margins. So what we need to do is we need to come up with what we consider a weighted contribution margin. Here's how we do that. We take the $25 contribution margin of product A, we multiply that times our anticipated sales mix. In other words, we plan to sell 30% of all our sales will be out of product A. So we take $25 contribution margin, we multiply it times our sales mix of 30%, and we end up with what we call a weighted contribution margin for product A of $7.50. Now we're going to apply the same process to product B. Product B has a contribution margin of $15, but we plan to sell a 70% of product B. So we now insert product B into the calculation, and it'll be 70% times our contribution margin of $15. So our weighted contribution margin for product B will be $10.50. So our total weighted contribution margin would be the basically be the weighted contribution margin of A and of B. So these would total to $18 per weighted unit. Now, in order to come up with our break-even point, the first thing we have to do is calculate, just like we do with our break-even formula in terms of total sales. We have to come up with our weighted contribution. We have to come up with our contribution margin ratio. Since we're going to be using the $18, we're going to call this a weighted contribution margin ratio. So we take the $18 weighted contribution margin ratio, we divide it by the sales prices of both product A and B, which is $45, and that means our weighted contribution margin ratio, the CMR in effect, is going to be 40%. So now we insert our fixed cost of $400,000. We're going to divide that by our 40% weighted contribution margin ratio. And what that says is that in order to break even, given the sales mix of 30% and 70%, we're going to need to generate $1 million worth of sales in the 30 to 70% sales mix. In other words, in order to break even, we should be able to sell we would have to sell $300,000 worth of product A and $700,000 worth of product B, which would be the 30% and the 70%. Okay, let's go on to the final slide for the presentation. And again, this is calculating the break-even point in sales for multiple products. Now, I presented this in a little bit different fashion than the previous slide, so you get a different view of another different view of how to calculate this, the break-even point in sales. Malibu Corporation has monthly fixed costs for $140,000. It sells two products for which it has provided the following information. It has product 1 and product 2. We have our sales prices of $20 each, and we have our contribution margin. It's already computed for us at $8 and $4 for product 1 and product 2. Now the question here then is, what total monthly sales revenue is required to break even if the relative sales mix is 40% for product 1 and 60% for product 2? Now if we take a look at product 1, we have the contribution margin already calculated, so we didn't have to do selling price minus variable cost. That information, the variable cost, isn't given to us, and we don't need it since contribution margin is already calculated. So product number 1, we have an $8 contribution margin times the 40% of sales equals $3.20. That's going to be weighted contribution margin. Product number 2, we have a $4 contribution margin, and that's going to be 60% of our sales. So we multiply the 60% times $4, and we're going to have a $2.40 weighted contribution margin. If we total these two together, our total weighted contribution margin then is $5.60. Now we take the $5.60 weighted contribution margin, we divide it by our selling price, which are both $20 each, which means our weighted contribution margin ratio, our weighted contribution margin ratio will be 28%. Now we're going to take our fixed cost and divide it by our weighted contribution margin ratio. So our total fixed cost in this case are $140,000. We divide it by the weighted contribution margin ratio we calculated in the previous step, and what we're going to see is we will have to have a combined sales of $500,000 in effect in that 40 and 60 ratio, which that would be necessary. We'd need $500,000 in that ratio to break even. So with that, that's the end of the exercises, and thank you for your time, and I'll see you back in class.